Good evening and welcome to Money Magazine. I'm Alan Booknia. China has been under intense international pressure to revalue its currency. And the question now has not been so much if, but when. It's caused a flood of speculative money to go pouring into mainland China and even into Hong Kong. Pressure has been mounting, mainly from the U.S., but also from a recent G7 meeting. They maintain the yuan, which is pegged at 8.27 to the U.S. dollar, is artificially weak. The U.S. administration wants to see an appreciation of 25 to 30% and is threatening to put import limits on Chinese textiles that are flooding the country since the lifting of quotas at the beginning of the year. Over at the Economist Intelligence Unit, the thinking is that a revaluation is imminent. Paul Cavey is its chief economist covering China.
Well, it's at least hearing the message. China obviously depends very heavily on open export markets in the rest of the world, and for its leaders to be ignorant of the protectionist pressure that does seem to be building in the US in particular would be doing a disservice to China's national interests. Having said that, China is going to move for what it believes is in its own interest, and it can't be seen for domestic reasons to be giving in to US bullying.
Robert Broadfoot, an economic risk consultant, doesn't think a revaluation of the yuan would hurt Chinese textile exports that much.
If you're looking at the labor component, the actual cost from China is very low. If you push it up 30% in currency, in terms, it's not that much. It's by the time it gets to the stores, the prices are significantly higher. I think China's afraid of getting unilateral action of discriminating against Chinese imports. It would like to avoid that.
But Broadfoot sees big upsides for China with a revaluation.
Commodities, in fact, will be cheaper in Chinese terms, so it will lower down some of those costs. It may make it easier for China to go and invest in some of those sources of supply abroad. So basically, a revaluation is going to increase China's strength as a consumer, increase its strength as an exporter of tourists, increase its strength as a foreign direct investor.
If there is a revaluation, then the big question becomes, in what form? Brian Colton, head of the Asian Sovereign Ratings at Fitch Ratings Agency, says China is not ready for a free float of its currency.
A free float generally is accompanied by a fairly open capital account regime, and China doesn't have that. It has a lot of restrictions on capital flows. And at the moment, the financial system in China probably isn't strong enough to allow them to radically open up the capital account, which would help a free-floating exchange rate work better.
The options open to China are widening the band in which the yuan can move up and down against the US dollar, or just raising the peg.
If we're talking about a revaluation of 15 or 20%, which frankly I think is very, very unlikely, the downside is perhaps a significant impact on China's export competitiveness.
5 or 10% probably wouldn't do too much damage, but the sort of 25, 30% that the Americans are pushing for, I think would increase the risk of overkill, of slowing this economy down too rapidly.
And how much the increase is brings with it other considerations. All the speculation on the yuan revaluation is bringing hot money into China. Foreign investors are snapping up China plays, reasoning that a higher yuan would make those shares worth more. But all that foreign cash going in brings with it inflationary pressure, something that probably won't go away if the increase in the yuan is a small one.
What it will mean is more difficulties in terms of this speculation. If they move by 3%, 4 percentage points, then it's going to encourage a lot of people to think, well, look at this, we're just at the start of the process. You know, if we invest in China now, then there's going to be more returns to come over the next few years as China's currency strengthens further.
Hot money is also flowing into Hong Kong, and a lot of that has to do with yuan speculation.
Whatever's happening at the moment, interbank interest rates in Hong Kong have been depressed, and that's one of the things why interest rates here in terms of prime rates are not rising nearly as quickly as the Fed funds rate. Some are coming here because of the IPOs and because, you know, there are Chinese assets here that they can invest in. Other people are coming here because they think if they invest here, China revalues its currency, then Hong Kong will revalue its currency as well. Now, I think the latter group are going to be disappointed.
Will this be a variable that causes Hong Kong to say, do we need to change our own peg system? Do we need to get away and de-link from the US dollar? I don't think that's in the cards right now, that as long as the U.S. dollar hasn't completely fallen out of bed against all major currencies.
Broadfoot also thinks Hong Kong will benefit if the yuan appreciates.
A revaluation is certainly going to make Hong Kong look like an inexpensive shopping place to mainland Chinese, because they're coming here now and helping to drive a consumer boom for retail luxuries, which are still cheaper here than in China because of tax differentials, which are going to remain. They're helping to drive the local property market. By and large, I think the Hong Kong economy, especially at the consumer side, is going to be stimulated.
Chinese central bank officials did meet with U.S. Treasury officials last night, but nothing firm was resolved.